Well, speaking of India, Ridham, and I know that a lot of people are going to be wanting to hear what you have to say as far as the stock market story is concerned. So let me get you to delve a little deeper on that. In the report, you talk about a quintupling of stock market investors from the current 62 million up to about 300 million. And that in a way captures the mood across equity markets and the momentum that's been built around the equity culture. Why talk about the decade? Let's get you to talk about when you believe we're going to be at the all-time highs. The expectation is anytime soon.
Yeah, Shereen, actually, I hate to go into these all-time high things, but yeah, we are not very far away. I think it depends on what the US markets do. Even though we have kind of decoupled, as we have seen over the past several months, the fact is that the US is still the largest stock market in the world, and it seems to be forming a bottom. If it does form a durable bottom, then I think we will make a new high. That's still to be seen. It's not our central case because the US is still struggling with inflation and with earnings. Very unlike India. India is not struggling with these things. So that's why India has done so well. I mean, just digest this number. This year, India has outperformed emerging markets by 34 percentage points. It's not happened ever before, this type of outperformance. It's really a very, very broken denominator. Emerging markets around the world are really broken. And India is therefore looking so good on a relative basis. But on an absolute basis, the market has not really gone anywhere. We've been digesting, the earnings. We've been digesting what was a relatively high P ratio, and things are, settling down. So it's been a typical consolidation, I would say, very benign consolidation. It could have been a far more volatile consolidation, but it's been a benign one. So I think we're prepping it up. I think 2023 looks like it will be a much better year for absolute returns. So yeah, let's look forward to that, and hopefully we can make a new high soon.
Yes, that is the expectation, and that certainly is the hope at this point in time. But, you talked about the benign consolidation rhythm, and while you've just outlined your bull case for India over the next decade, as far as the markets are concerned, outside of the external factors like what the Fed is likely to do, and we will know later tonight, but what could be the near-term triggers as far as our markets are concerned?
I think one of the things that, again, as I said, the near-term triggers are probably lying in the US rather than in India. So one thing we need the Fed to articulate that they think inflation is peaking, which is what I think is happening in the US. And if they think that inflation is peaking, then a lot of the bond market losses in the US will start reversing, and that will then feed itself into the equity markets. The next thing, of course, is what happens to US earnings, which will probably be quite bad over the next several months. Back in India, I think we'll focus on the earnings season. I think the earnings season is going to be one trigger to watch out for. We have our own central bank, which has still a little bit of way to go before rates stabilize. So that's another thing that we'll be looking at. I'll be looking closely at commodity prices as well, because it doesn't look like the Russia-Ukraine war is yet settled, and it may be a source of bad news. So we have to keep an eye on that. Fertilizer subsidies in India have gone up significantly this year, and the underlying assumption is this will roll back next year. So keep an eye on that. Ammonia plants across Europe have been shutting down because gas prices are too rich. So we need to see those things come back and fertilizer prices to settle lower. That'll be good for our macro. And then, of course, we'll watch for how investments shape up. Because, Shireen, at the end of the day, to get a durable earnings cycle, which is what we are forecasting for India, needs a lot higher investment rate. And it requires corporate optimism. Now, I'm sensing that companies in India are getting more optimistic. They are starting to run into some capacity constraints. And therefore, there should be a pretty good capex cycle in the next 2-3 years. And that will be great for earnings. So that's something that we'll watch out for as well.
Yeah, and that wait has been on for a while now, Ridham, in terms of the private capex cycle turning, and it currently continues to still be the government that is driving capex. So we will have to wait to see, as you point out, perhaps over the next 2 to 3 years. But I want to focus a little bit on the the manufacturing story, because that is something that you feel particularly confident about. We were stuck for over a decade, at about that 11 to 12% percentage of GDP as far as manufacturing share is concerned. Currently at about 15%. You believe that we have the potential and the ability to go to about 20% over the next decade, in light of the many factors that you've just spoken of, including, of course, the multipolar thesis playing itself out and the China plus one advantage being enjoyed by us. How confident do you feel of being able to break out of this manufacturing range that we've been stuck in for over a decade plus?
Actually, Shireen, manufacturing share in GDP has been declining for 3 decades now. So it's not just the last 10 years. In fact, it's ironical that in 1991, what was dismantled was all the constraints on the industrial sector. All the reforms surrounded the industrial sector, whether it was relating to pricing, capacity approvals, supply of resources, etc. Ironically, it's the share of the industrial sector that actually declined. I think there were many constraints on the ground. And, we used to joke about this several years ago that it was cheaper to import steel from Russia than bring it from Jharkhand to Mumbai. And that was, the basis of the problem, which is that we just didn't have a competitive logistics cost. Now, I think that has gone through a big change over the last few years. Infrastructure has been put in place. There's a huge focus on logistics, and therefore it has become more competitive. Of course, there are constraints in China as well, which is feeding into this story. But I think India is set to now become a meaningful part of the global supply chain. And a lot of companies will reveal this to you that they're receiving orders. Hitherto, they didn't have access to those orders because Chinese companies used to take those orders, and they are now all set to increase capacity to service these export orders. On top of this, multinational companies are looking at India as a very attractive destination. To obviously put up low-cost manufacturing. Our labor costs are less than China now. That wasn't the case 10 years ago or even 5 years ago. So now we're lower than China. And B, because we have a serviceable home market. Look at mobile phones. We are very big consumers of mobile phones. So it makes a lot of commercial sense to set up capacity in India, service that market, and then take the excess production and put it out of India. So I see these are the changes which inspire us to believe that manufacturing is now set to gain share in GDP over the next 10 years.
Ridham, we are going to take a break, but don't go anywhere. We return with Morgan Stanley's Ridham Desai on why he believes this is going to be India's decade. Welcome back. You're watching On the Record with me, Shereen Bhan, and I'm in conversation with Morgan Stanley's Ridham Desai on their blue paper on why they believe this is going to be India's decade. You're also very bullish on the consumption story, Ridham, and you believe that we are going to see a significant, in fact, a seminal shift as far as discretionary spending is concerned. Build that case out for me a little bit. What could be the triggers that move the per capita as well as bring about this major shift that you are talking about as far as discretionary spends are concerned?
So, Shireen, that I think is the most important part of this story. The pyramid in India, the income pyramid, is set to invert. So we have a lot of people sitting at the bottom of the pyramid who are extremely poor, and they're going to move up the pyramid. And at the top of the pyramid, we're going to get some, major change. So currently, for example, the households in India that earn in excess of $35,000 a year is about 5 million. Based on our forecast of where we see GDP going and where we see the population going, this number is likely to go to 25 million by the time we get to early 2030. So that's a 5-fold increase in the number of people who can buy Louis Vuitton purses. I mean, you look at that. Louis Vuitton's global brand ambassador is now Deepika Padukone. And I think they're sensing this. They're sensing that their big market is going to be India. This is what happened to China, 15 or 17 years ago. China was the biggest consumer of luxury goods. That's at the top end of the market. At the bottom end, as people rise out of that very low income levels, they suddenly find room to spend on everything that is not staple, which is, forget roti, kapda, makan. These are the 3 staple things. Even painting a home in India is discretionary. Sending your kids to school is discretionary. Buying a internet connection is discretionary. So a lot of that money will get spared up to do this. And this is basically the natural transition that's happening as we move from the $2,000 per capita to $5,000. And it's embedded in our GDP forecast. It's being driven by the fact that India is becoming the office to the world, is becoming the factory to the world, and is also being driven by the fact that energy consumption is set to rise. So all the factors that I mentioned earlier are driving this big consumption story. I think discretionary consumption will surprise on the upside in the coming 10 years. And a lot of subsectors will surprise us quite meaningfully because we've not seen that happen before. Things like travel, things like education, things, home effects, these are all likely to see major increases in spends. Even buying of residential homes, because we've been in a 10-year bear market as far as home purchases is concerned. That's also breaking out now. So lots of things changing on the ground in India.
From a market perspective, from a thematic and sectoral perspective, what will you be watching out for?
So Shireen, first up has to be financials. Okay, credit to GDP is 57%. Corporate credit to GDP is 46%. Even if you adjust it for India's low per capita income, India is under levered. It just doesn't have enough leverage on the balance sheet. And that's, I think, set to change. Oaken will allow greater credit dissemination. And, one of the headline views that we have in this report is that credit to GDP will go from 57 to 100. That will drive a 17% compounding of loan growth. So just imagine what's going to happen to bank earnings in the next 10 years. Yes, Oaken is a disruptive technology, but it's also going to help the banks lend, in a better way. And then you top this up with, IBC. I think the chances are that the next NPL cycle will be less punitive than the previous one. Because IBC will allow banks to recover at a much better rate, and IBC has now settled down. A lot of that law has gone through a lot of testing. So banks or financial services is top of the pack. Consumer discretionary, I've already mentioned that. I think that's going to surprise on the upside. Make your choice. There are lots of discretionary companies that will do very well. I think you should watch out for technology. It is going through a rough patch right now because of the potential slowdown in the US. But I think digitalization that you mentioned is not just an India theme; it's a global theme. Companies are going to continue to spend to digitalize, and nobody in the world can deliver those solutions at the rate at which India does, both scale as well as price. And Indian companies will be at the forefront of delivering those solutions. So I think when we come out of this rough patch, which I think we may have already in terms of share prices, we may not have come out in terms of profits and revenues. I think the IT services companies could do well. And then industrials. You mentioned defense, that's part of industrials. We're going to see a major indigenization of defense spending. So Indian defense companies should do well. Industrials overall, because I'm quite bullish on capex, I think should do well. So, these are the 3 or 4 sectors that stand out in terms of benefiting from the new India that we talk about.
Ridham, finally, before I let you go, what could go wrong?
No, lots of things can go wrong. None of these forecasts are secure. There are a lot of uncertainties in the world. We could not have predicted COVID, for example. Who knows what's the next big crisis that's coming to the world. But we've tried to take a shot at that in this report. There are 4 or 5 things that we highlight. I think the first thing to bear in mind is that we have an election cycle coming up in a year and a half. I think that will be critical. It'll be important for the Indian electorate to put in another majority government. Yes, coalition governments do their work, but it always becomes a bit of a struggle, and economic agendas kind of take a back seat. So hopefully we don't get a negative surprise in the 2024 elections. The second thing we need to watch out for is global growth. It does look very tentative. In fact, it's quite possible that India does not have the tailwind that China had when global growth was averaging much higher than it is today. So we will be in a sluggish global growth environment, but we will not be able to tolerate multi-quarter recession, for example. At the end of the day, India exports 20% of its GDP. It's not a small number. Even though we are gaining share, and we didn't touch upon this, but let me just highlight this to you. We think that India's share in global exports will double in the next decade. So we will be able to withstand some slowdown in global growth. But if it's a deep and broad recession, then it will create pain.
Ridham Desai, always a pleasure. Many thanks for joining us here on the record to take us through why you believe that this is going to be India's decade for the taking, risks and caveats aside. But thanks very much. Always a pleasure speaking with you. Appreciate your time. That's it then on this edition of On the Record. From all of us here, goodbye. Many thanks for watching.